Is the gold price broken? Because right now the gold prices continue to dump. Meanwhile, war is flaring up once more across the Middle East, with the Strait of Hormuz being effectively closed to shipping and the oil price surging once again. If you've been taught that gold is the ultimate safe haven asset when the world catches fire, then the market right now is proving you completely wrong, because gold just slid down towards the $4,000 range while bombs are literally flying in the air. In this video, I'm going to show you the hidden macro liquidity forces that are actively crushing the gold price, why the war isn't saving it, and the exact levels that you need to watch for next. Do me a favor, hit the like button, and let's get into today's video. Now guys, jumping across and looking at the gold price, you can see something happening that probably shouldn't be happening. Iran has attacked at least 3 commercial vessels near the Strait of Hormuz, including a Qatar-linked LNG tanker and a Saudi-flagged crude tanker. Then, the US launched retaliatory strikes, with one report saying that they hit over 140 targets in a single weekend. Iran then hit back at allied targets in Bahrain, Kuwait, Qatar, Jordan, and Oman. And the Strait of Hormuz, which handles roughly 20% of the world's daily oil and LNG, has basically ground to a halt. Just so you can understand the severity of this, the pre-war baseline was 120 to 140 ships a day. By Sunday, only 6 vessels had made it through. 6. That is literally a full-blown geopolitical crisis. So the textbook says that we should see gold rocketing to the moon right now. Yeah? But something isn't right, because it's doing the complete opposite. You see, gold is now down over 25% from its January all-time high of just over $5,500 an ounce, down roughly 20% for the quarter. So what on earth is going on here? Are the buyers idiots? Should we not trust gold anymore? Well, this is what I call a safe haven paradox. You see, once you understand the mechanisms behind it, you're going to see gold in a completely different light, because the news isn't what's driving price. Liquidity is. And this is important for crypto as well. So let me explain. Now guys, the real driver here is none other than the US dollar. You see on this chart, you've got the dollar index, the DXY, and right now it's holding firmly above 101 levels in a rising channel. And when the dollar is strong, gold, which is priced in dollars, gets more expensive for everyone else around the world. So strong dollars equals weak gold. That's the relationship, and it's been holding like glue. And it's the most important part, because the US 10-year Treasury has just hit a 7-week high, somewhere around 4.6%. It climbed from about 4.38% a week prior on a 7-day streak of increases. And here's why that matters for gold. Gold pays you nothing. No dividends, no yields, no interest. It just sits there, looks shiny in a vault somewhere else. So when a treasury bond is paying you 4.6% for basically zero risk, why would a massive fund park billions of dollars in an asset that pays them absolutely nothing? Think about that for a moment. The higher those yields go, the more painful it is to hold gold. And the Standard Chartered Bank points out that US yields right now are near their highest since 2008. And this is the mechanism that everyone screaming about the war is completely ignoring. Now I want to be honest with you, because I don't like oversimplifying things. Historically, the correlation between gold and real yields was very strong and very negative, around minus 0.73. But since 2024, the relationship has actually weakened a lot. Why? Well, because the central banks have been buying gold aggressively, and we'll come back to that in a moment because it's massive. But right now in the short term, the fast money is running the show, and the fast money follows yields. So the question is, why are yields even going up during a war? Well, here's where it gets really interesting. Normally a war means fear, and fear means that the Fed cuts rates to calm everyone down. But this time, the war is doing the opposite. Brent crude jumped over 4% to around $79 a barrel, up from pre-war baselines of around $72. And expensive oil means one thing for the Fed: inflation. The market isn't pricing in a dovish Fed, it's pricing in a hawkish one. Now guys, this is the part that nobody else is talking about right now. There's a new sheriff in town at the Federal Reserve. Kevin Warsh, who you probably heard being mentioned quite a lot across crypto and finance videos. Now Kevin Warsh was sworn in as Fed chair back in May of 2026, and he's a completely different animal to the previous Fed chair. You see, he ripped up the old forward guidelines that boiled it down to one blunt line: the committee will deliver price stability. That's it. and at his first meeting, the dot plot leaned properly hawkish. 9 of the 18 policymakers projected at least one rate hike this year. The CME FedWatch tool right now is pricing in a roughly 70% chance of a rate hike by September. A hike, guys, not a cut. After years of everyone begging for cuts, the market is now betting the exact opposite. And Governor Waller has openly said that the Fed will not cut rates just to finance government debt, pushing straight back against the White House, who, as you know, have been pushing for lower rates for a very long time. This is a higher for longer regime, and it's suffocating the gold price, as well as crypto prices and a lot of other things. The inflation data backs it up too, with headline CPI hitting a 3-year high of 4.2% in May. Core PCE, the Fed's favourite gauge, hit 3.4%, the highest reading since October of 2023, and it's been above their 2% target for years now. So think about what's actually happening here. The war spikes oil. Oil spikes inflation. Inflation forces a hawkish Fed. A hawkish Fed pushes yields and the dollar higher. And high yields and a strong dollar crush gold. The war isn't helping gold. The war is literally the thing that is hurting it. So the question that everyone is asking here is, where does gold go from here? Now guys, let's think about this logically, because the first major line in the sand is $4,000. The World Gold Council's own valuation framework flags $4,000 as a critical fair value threshold. If gold breaks and stays below that, it could trigger a wave of technical selling. Below that, and the next big support sits around $3,940 to $3,950 per ounce. And in a genuine worst case scenario, some analysts warn of a drop as far as $3,400 to $3,500. Gold right now is currently trading below its 50, 100 and 200 day moving averages, with several death crosses printed back in June. And that, as you're probably aware, is a very bearish structure, plain and simple. Now, on the flip side, the levels I'd be watching for a reversal are these. A drop in the dollar below 100.5 would be the first sign of dollar weakness, and the 10-year rolling back towards 4.55 to 4.6% zone, which would be the clearest signal. And this is something I talked about yesterday with regards to the Bitcoin price, because Bitcoin is following closely the Japan M2, which is very closely linked to what happens in the dollar. When you have a strong dollar, the Japanese M2 typically falls, and this is what Bitcoin has been kind of following along with as well. And if you want to know more about Bitcoin and crypto, make sure you check out my other channel, The House of Crypto, and that last video I made, because it talks specifically about what Bitcoin is following and what altcoins have historically followed it as well. Now, this right now is the counterintuitive part that most people are getting completely backwards. If oil breaks above $100 a barrel, then Goldman's modeling says that it adds 3 to 4 basis points to monthly core inflation, which obviously means more pressure on the Fed, and therefore more pressure on gold, not less. So a bigger war could actually push gold lower in the short term. Think about the maths on that for a second. But now, let me show you the other side of this game, because this is where everything gets pretty fascinating as far as I'm concerned. While the fast money and the ETF crowd has been dumping gold, panicking about yields, somebody else has been quietly loading up. The central banks. China's central banks, in fact, have just extended their gold buying streak to 20 consecutive months, adding nearly 15 tons in June alone, its biggest purchase since back in 2023. And Poland grabbed 82 tons in the first half of this year. The World Gold Council surveys shows a record of 45% of central banks planning to buy more gold over the next 12 months. Meanwhile, ETF investors sold out around 2.1 million ounces in June. See the game here. The masses, or the paper gold crowd, are selling the dip in a panic. The slow money, the central banks, are buying the exact same dip on de-dollarization grounds. This is literally how it happens every single time. Retail panic sells, smart money loads up at decent valuation. That's why the big banks still have serious price targets. In fact, Goldman is around $4,900 for the year end, with some reports suggesting that HSBC is targeting the $4,700 range. But Goldman itself warns that if the Fed actually hikes rates, then gold could slip towards $4,400 for the first time. And this is exactly what history has taught us. Look at the 1990 Gulf War. Oil prices doubled, and gold saw a measly 12% bump before quickly reverting. Why? Because there's no deep recession and no aggressive money printing. Compare that to 1979, where gold ran from $220 to $850, because that came with stagflation and a monetary policy. Oil shocks only trigger lasting gold rallies when they cause a severe recession, or they force the Fed to begin easing. And right now, the Fed is doing the complete opposite. They're seemingly talking about tightening. That's the whole paradox in one sentence. So the biggest mistake you can make right now is buying gold purely off the war headlines while ignoring the macro plumbing underneath the entire system. Until that 10-year yield begins to cool off and the dollar finally begins to weaken, this safe haven paradox is going to keep suppressing the gold price no matter how loud the news cycle gets. And the reverse comes when the war stops being an inflation story and starts becoming a recession story. When demand destruction from expensive oil finally scares the Fed into easing, that's when gold flips. And with the central bank buying every dip, there's a real structural flaw building underneath all of this. But watch the liquidity cycle and not the news cycle, because the key dates to watch are the CPI releases, the PCE prints, and the next Fed meeting at the end of the month. So, what do you think? Do you think that the war will eventually overpower the Fed's high yields and send gold flying, or do you think gold is headed lower first, far below the $4,000 range that it sits in right now? Leave a comment down below and let me know which side you're on. Do me a favor as well, hit the like button, and if you want to understand real macro forces driving your money, make sure that you subscribe to the channel, and I'll see you very soon in another video. Bye bye.